Welcome to today's explainer. Look, if you've ever felt like you are grinding harder than ever, your revenue is shooting up, but your bank account somehow just doesn't reflect your sweat in tears, you are in exactly the right place. Today, we're diving into the Trade Owner's Playbook on cash flow. We're going to unpack exactly what it takes to keep your revenue flowing smoothly and make sure your business isn't just surviving, but actually thriving. Picture this. It's April. You just wrapped up your best quarter ever. The numbers look absolutely incredible. You pulled in $90,000 in revenue. Your accountant is thrilled, your jobs are stacked back to back, and you're thinking, finally, things are clicking. But then, Friday rolls around, payroll is due, you open your business banking app, and your stomach literally drops. There is exactly $1,400 sitting there. The math just doesn't add up, right? Why? Well, because the money was there on paper, but it vanished in practice. The playbook is super clear on this. If you don't understand why this happens, it is going to keep happening. All right, here is our roadmap for today. We'll start with the silent business killer, then move into the deadly timing gap, getting paid faster, building your cash reserve, mastering supplier relationships, and finally, we'll wrap up with the weekly cash review. Okay, let's jump right into section 1, the silent business killer. The source material points out a really surprising truth here. More service businesses actually die from cash flow problems than from bad products, poor sales, or a lack of hustle. You can absolutely be profitable on paper and still go completely broke. It happens every single day. And the text shows that this happens because business owners fundamentally misinterpret their financial health. We tend to confuse what we've earned with what we actually hold in our hands. So here is the absolutely crucial distinction. Profit? That's just an accounting concept. It is literally paper math based on the invoices you've sent out into the world, regardless of whether anyone has actually paid them yet. Cash flow, on the other hand, is physical reality. It's the actual dollars that have landed in your bank account. You can invoice $50,000, show an $18,000 profit on paper, and still have $0 to pay your crew on Friday because those invoices are just sitting on your customers' desks, gathering dust. Which leads us perfectly into section 2, the deadly timing gap. What's really fascinating here is that it's delays, not your work ethic and not your pricing, that create these deadly financial dips. The core villain of every single cash flow problem is a mismatch. It's the timing gap between when you spend money to do the job and when you actually get the money from the customer. Let's trace the life cycle of a standard job to see this in action, because this really brings it home. Day 1, you estimate the job. Day 2, you buy materials, and boom, cash flies out the door immediately. Your crew works hard all week, you finish up on day 6, and you send the invoice. You did everything right, but the customer doesn't process that invoice and pay you until day 27. Your cash left your account 24 days before it came back. That 24-day gap, that is exactly where the source says businesses truly choke. So how do we fix that? Let's move to section 3, getting paid faster. The text highlights a hardcore rule here. Every single day an invoice sits unpaid is a day you are personally financing someone else's project with your own hard-earned cash. And you know what? The collection problem isn't usually a customer problem. The playbook frames it as a systems problem. The fix is rigid infrastructure. That means requiring a 40 to 50% deposit on jobs over $2,500 to cover those initial materials. And you've got to adopt a strict same-day invoicing rule. If you're on the job site at 4 p.m. when the crew wraps up, send the invoice from your phone before you even put the truck in drive. Seriously, do it right then and there. I want to pause on this quote straight from our source material because it hits incredibly hard. Hope is not a cash flow strategy. Sending an invoice out into the void and just hoping they pay you in time for your next payroll, that is a total recipe for disaster. You have to take control. To do that, the strategy builds into a really structured 5-touch follow-up system. It gracefully escalates things without burning any bridges. Check this out. Day 1, shoot a quick text confirming the invoice was sent. Easy. Day 3, a friendly check-in. Day 8, a direct reminder of the due date. Day 11, if they still haven't paid, you send a firm message notifying them that the agreed-upon 1.5% monthly late fee now applies. And by day 21, you stop texting and get on the actual phone for a direct commitment. The source argues this works like magic precisely because it's predictable and totally professional. Now, section 4, building your cash reserve. Because even with perfect collections, things go wrong, right? The playbook makes a great analogy here. Operating a service business without a dedicated reserve account is exactly like driving your fully loaded work truck without insurance. It feels totally fine right up until the exact second it doesn't. You don't build a reserve because bad things might happen. You build it because bad things will happen. Weather, broken equipment, you name it. The reserve is what determines whether a bad week is just a minor headache or a total business shutdown. The text outlines how to build this systematically in 3 layers so you don't starve your day-to-day operations. Layer 1 is your survival reserve, just 5 to 10 grand to handle minor immediate emergencies. Layer 2 is your operating reserve, 1 full month of your fixed expenses. Think insurance, truck payments, software. Finally, Layer 3 is your full buffer, 2 to 3 months of expenses. So how do you actually get there? The automatic percentage method. If you're starting from zero, simply set up an automatic sweep of 5% of every single payment you receive into a separate high-yield business savings account. As your reserve grows, you can tweak that percentage, but the golden rule is you never, ever stop funding it. Moving right along to Section 5, Mastering Supplier Relationships. The source points out a massive missed opportunity here. A lot of contractors treat their suppliers like vending machines. You show up, put cash in, get materials out. But managed correctly, the text explains your suppliers shouldn't be vending machines at all. They should be powerful short-term financing partners that can practically eliminate your cash flow gaps. The secret weapon? Securing net 30 terms. This means you get the materials today, but you don't actually have to pay that invoice for 30 days. Think about that. You order materials, finish the job, invoice your customer, and get paid, all before the supplier bill is even due. The job practically self-funds. It's a total game changer. To make this happen, establish a solid purchase history, then sit down with a manager and ask for a credit line. Also, the playbook emphasizes ruthless ordering discipline. Overpurchasing is a silent margin killer. If you buy 2 extra squares of premium shingles just to be safe on a $10,000 job, and they get damaged bouncing around in the back of your truck, you literally just threw $400 of pure cash into the garbage. Keep a tight leash on those job-level budgets. And that brings us to our final part, Section 6, the Weekly Cash Review. This is the climax of the playbook. The text proposes that replacing all that financial anxiety with actual solid financial management takes exactly 15 minutes a week. Just 15 minutes. Because you cannot manage what you do not measure. Glancing at your bank balance on your phone while you're drinking your morning coffee isn't management, it's just stressful. A weekly cash flow review gives you a proactive, crystal-clear picture of your business's health. The playbook lays out a simple 5-step process to run every single week. First, check your current bank balance. That includes both operating and reserve accounts. Second, list your outstanding invoices. You need to know exactly what cash is out there owed to you. Third, calculate your upcoming 14-day expenses. What's flying out the door for payroll and supplies? Fourth, you do the math to find your 14-day cash position. That's your current balance plus expected cash in minus expected cash out. That number right there is your crystal ball. If it's negative, you've got 2 full weeks to fix it before you hit a wall. And finally, step 5, write down up to 3 immediate action items based on that data, like making a collection call or tweaking an upcoming estimate. Which leaves us with this one absolutely crucial question from the playbook. As of this exact moment, do you know your 14-day cash position? The source is clear. If you don't, you are flying blind. It might just be time to block off 15 minutes and run your very first weekly cash review today. Thanks so much for joining us to unpack this framework.